Hello everybody and welcome back. Well, it may come as no surprise to many of you that we have just witnessed the second largest short selling period in history since recorded history back in the global financial crisis. Markets across the world have fallen off key levels. We've also got crypto such as Bitcoin moving below raw production cost, which we'll be taking a look at later, and everybody is pretty fearful. But where a massive short happens, usually that's passed by some type of thing such as a short squeeze. So is it time to do the short squeeze now, or are we moving to the fabled 200 simple moving average? Stay tuned as we go through the markets for the week ahead right now. See you soon, everyone. This will be a good one. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos daily. If you like any of those markets, consider subscribing and of course give us a thumbs up on the video if you enjoy today's content and find value in it. Let's talk about this prime book US equities. Of course, the largest short selling for a very long period of time. As the data's come out, we've ended up seeing the composite man or Wall Street short selling at a rate that has only been surpassed one time in recorded history during the global financial crisis. You'll notice down here, all the way back on this chart anyway, we didn't see a point that was any larger in terms of general short selling. Now, wherever there's a great short sell, there's usually a potential for a great short squeeze. So that is squeezing and short covering. Notice back in the previous history, with the lowest one that we've got here on recorded history, we see a subsequent squeeze that occurs. Now, that doesn't mean that the market goes off and goes to all-time highs or any of those types of things, but certainly it brings in the stats and brings in this idea that there's a chance that there might be some covering in the next week to 2 weeks of trade. And of course, technical analysts and people that are in the markets want to be looking for these types of information, these types of things coming through. Now, it doesn't mean that insiders or people in companies weren't buying. Of course, we did see insiders on certain metrics still buying their stocks at a pace that has been faster than before. But this is the pure hedge funds, the pure market manipulators out there getting involved in the market. So after a good period of manipulation down, what does Wall Street tend to do, or the composite man? Well, I would like to focus on a few things here. This is some of the periods that we've seen peak to trough declines of over 20% in the SP 500. You'll also notice time from peak to troughs, 7, 8, these short ones, 3, 3, 3, and 1. Now, whenever it's been a really short period of incredible selling, we often do have 1 month, 3 month, 6 month real movement towards the positive after that. So you'll notice here we have some decent little kind of squeeze runs that end up giving relatively good percentage over that period of time. Another thing that we want to be focused on is, are we having a recession? Are we in a recession in the next subsequent 12 months? Most metrics are pushing towards 60 to 70% chance that the US is going into recession. And of course, the bond market, while it hasn't hit my favorite thing to see in the markets at this stage, which is 50% of all yields inverting, make sure you subscribe because we will tell you when that happens. We haven't seen that yet. So it really means that the bond market hasn't told us. It's inverted on the 2 and 10 year, which is very important, and we'll look at that in a minute, but it hasn't shown us everything that we'd like to see usually from a pure recession standpoint. If we think about speed at which the markets come down and put it against other subsequent bear market periods, it's pretty fast in terms of the average. And you'll notice that if we are not in a recession, this has often been where the market has tapped out and said, you know, enough's enough. This is not a recession and it's turned around. Of course, we don't know that. Whereas in other times, recession in subsequent 12 months, you'll notice even the speed here has been incredibly aggressive when compared to other markets. Now, you might say, well, this is because of the asset bubble, the huge asset bubble that the Fed has created. Of course, the speed at which the algorithms are in this market, the speed at which the data comes out makes it faster. I do agree. Compared to average, that makes sense. But we do often have these kind of relief in both situations. We have these relief periods of either whipsaw, accumulation, or of course, some type of rally that can occur around these periods of time. Now, what happens at the end of the year and the subsequent next 6 months, that could be totally different. Remember, we're still in a midterm year and we're not even talking about the midterm elections, which tend to create volatility in the market regardless. But interesting where we're at the time we're at, and of course, what the potential is here of a squeeze considering the massive shorts that came into the market. Let's talk about a few other things that we want to see turn around before we say, okay, yes, this market is finding support. It is really finding buyers. One of the things that you always look for is things like this, which is the 2-year. Obviously, this is very important to the market. If the 2-year goes down and starts to actually stabilize in terms of declining, that can be a positive sign for the market. The market hates the 2-year. And if you think about it and you load up the SPX over the top and go to something like the daily, you'll notice that the market has really subsequently not done well during these periods of extreme 2-year runs. When the 2-year stabilizes, the market can therefore also stabilize and potentially have little runs up. And of course, if it goes down, look at that correlation there. Very good correlation, something that you want to be considering on your charts moving forward. US 2-year versus 10-year, we talked about bond yield inversion. Obviously, we're right on it. We yield inverted twice now. This is a usual sign of a recession coming in the US. We've talked about it a lot. We've said this is one of the most important things, but I also want to see 50% of all bonds inverting for that to be even more clear. So let's talk about the US dollar. A lot of people don't know, but the dollar can dictate during times of fear. This is of course, the dollar index, not really the real cash dollar. It shows us the flow of money around the world and whether the flow of money is risk on or risk off in terms of these markets to a degree. And we had a massive breach the other day, which shorted the dollar. Then it rallied back up, obviously trapping people into a serious buy. And now we're at, ahead of the US market open, a super critical zone. Effectively, if the market gets through this area, it's changed trend towards the downside. It's already got a monstrous change that happened here. And nothing has really happened other than at this point, you would be saying, okay, it looks like the US dollar is shorting. Now, because of the squeeze that we've seen, or the potential squeeze that we're going to see, of course, shorters coming through, covering up, and now moving towards the long side potentially. Could this coincide with something like that? This goes down, shows us that money's going back into bonds, back into the SP 500 and into some of those markets. We'll move over to the gold market as well. If we scroll down to the 1 hour, I've been pretty bullish on gold here for a few weeks. And I think rightfully so. We've obviously got some key points here coming into the US market, a defended zone sitting around that 1835 area. This is an area that is very critical for the bulls to hold. And if they fail to hold it in the next 24 hours, next up, 1820, 1815. So you don't probably want to see that. However, we get a bull buy. What a lot of people look at this as a double bottom. Of course, I think it's already looking relatively good. Hopefully it continues to go that way. And we move towards testing this previous supply area. And if we breach that, then of course we could be going to some serious numbers here for gold. A lot of people are starting to get excited for gold. Gold can't really do well until the US 10-year and 2-year start to drop. That's kind of like an almost prerequisite. I know it doesn't make sense to a lot of people, but believe me, it is a correlation out there with lowering yields is usually a good thing for gold. US oil, big drop off ever since we discussed this change of trend that happened up here on that 1 hour where it breached underneath the defended area, a super critical point here for oil. It's dropped and pretty significantly fallen off. It's now in a massive consolidation range. Why? It's ahead of the US market. The US market hasn't opened yet. We cannot get the idea of whether it's risk on or risk off. You probably want to see oil dropping a little bit more if you're bullish on markets at the moment. If oil goes up, of course, that means that we've got problems in terms of inflation, and oil is not usually a great thing to have going up in a time of where people are feeling a little bit poorer. And of course, the gallon cost, everything like that is too high. So very big consolidation. This could be accumulation for a breakout, or it could also be a massive distribution short. Whenever you get a market tending to hold like this, it usually means a coiling effect with a big move set to happen. So of course, the breach here will be a very important trade and concept over the next couple of hours. Before we get into stocks, I just want to talk about a super interesting concept, and this is Bitcoin in comparison to production cost and of course electricity cost. So Bitcoin fell underneath just its raw electricity cost at the current parameters of difficulty for mining it. So that means all the miners out there are making $0 or very basically nothing on getting their Bitcoins created. And that's not including the total cost, just the electricity cost. This hasn't happened many times before where it's fallen through this range. And usually what has happened is that there's been a slight difficulty change that happens, but this is crazy stuff. So Bitcoin is now cheaper to buy than it's actually cost to produce, just from the pure electricity standpoint. And this, of course, can mean that either Bitcoin is completely failing, or another thing is Bitcoin is in a zone where maybe some whales might want to come in and say, hey, slow down right there, guys. We want to, of course, pick it up. We saw the market go all the way to 17.5. That was pretty critical. And if we move over here and I just load up a Bitcoin chart, I'll just show you how you could get a level like that and kind of come to those conclusions. If you go to the daily, you'll notice there the 17 kind of 6 level, there it is. And that's the previous little level of demand. And as you can notice here, some wicks have appeared on this market showing that at least there's some whale buyer here trying to show some reprieve. Big level for Bitcoin moving forward is 23,000 still, like we cautioned and talked about the other day. And we've got some other levels around 21 as well. So Bitcoin's starting to form a base, but it's not quite there just yet. Let's talk about some other broad markets. So we'll just talk about the FTSE here quickly. FTSE coming down, obviously looking towards breaching out. Why can't it do so? It's waiting for the US. I mean, a lot of these markets are waiting to see what Wall Street wants to do after its massive short sell that they like to, make sure they make a lot of money on in the previous week, being the quadruple witching. So that big short sell came through during quadruple witching. What a surprise, hey? So here we've got the FTSE. It's sitting on a critical point ahead of the US Open. We've got the ASX 200 sitting on a critical point. I think all of you could see this ahead of the US Open. We've got IWM, which is the Russell 2000. What's it doing? Kind of just floating around in this little area down here, and it doesn't have too much direction on it yet. We do have a critical point moving forward, 175, 174.5. That will be big, but of course before then, I expect something like the SP500 to give us some decent signals. Let's move over to the Nasdaq. So the Nasdaq is recovering relatively well here in the futures market. There's going to be a gap, at least all things considered, between where the market closed on the Friday and where the market's going to open on the Tuesday. That allows shorters to come in and potentially grab liquidity. There's going to be some buying, you would think, around that 11.2. That's going to be a level that some people might fight it out for, and some day traders might be looking at that level. But the biggest critical level moving forward on the higher timeframes is going to be around this 11.8 area. That's still quite far away percentage-wise, but think about it. If we do this, we change trends on so many timeframes, 2 hour, 3 hour, 4 hour, even the daily. Everything changes towards the up. And I think that's going to be a big signal for a lot of people out there that the squeeze is occurring in terms of the covering, and that covering is going to go, hopefully, to fill some of the gaps. We'll move over to the S&P 500 just to understand where the gaps really are in these markets. We'll go down to the 1 hour, and you'll see from the real market action, it didn't really look like it was turning just yet. We do have 1 gap, 2 gaps, 3 gaps. Aggressive selling, second biggest in history recorded. Makes sense why we have so many gaps now, yeah? And all of these could be, of course, filled through some kind of short squeeze. Now, if the market is going to go down and pressure further lows, what becomes the logical area that it should go to? Just so everyone is aware, the general area that most people are thinking at this stage is somewhere around this 200 SMA. And that sits us around the previous highs that were caused in September and November of 2020, and of course the 3,500 level as well. So this will be a big one. If shorters get a new low in throughout this week, you could expect further selling down to this level. A lot of people are starting to cause that. And most people's reasoning why that could even happen is because they believe on the VIX that we haven't seen capitulation fear. If you go through the VIX throughout history, most of the lows have been put in place with incredible fear zones. Now, that doesn't mean that this fear spike was the low, but that shows that real fear or capitulation trade coming through. This time around, we've hit 35 a lot this year, which has been the low. So it's been more orderly in terms of pure fear coming through the markets. Some people believe that we're going to get one more spike that's going to form like a 40 or a 50 plus VIX, and that will hit and coincide with that level on the markets. And of course, the S&P 500 will end up being at around 3,500 at that point. The bear case is strong, but I think we need to see the low print before that occurs. Let's talk about the futures market. And of course, I didn't want to bring this chart up without talking about the rest because it looks crazy when you first see it. Look at that. It's a green fest. And the reason why it's there is because of fibs. But let's talk about this box here, probably the most important area. We know where the lows are. This is, of course, the futures market. So it's been trading outside of the US market. And we know where we had that previous supply problem, which is here. So at this stage, the market's going to open up above this level, technically be first time frame changing trend, which is, you know, you would think, yeah, okay, if that happened, that's a positive, but it hasn't fought off the previous supports, previous demand area, becoming, of course, this big resistance zone as well, or supply area. You breach that, pull back in the market's probably most likely to grab liquidity, maybe even fill the gap, and then hopefully a movement forward. The other solution is shorters come in around this session today and they try to session sell it. If that occurs, fill the gap, maybe some buyers try to commit there. But if the market keeps falling and it gets underneath this area, I just don't see a level other than 3,500 at this point. That the 200 becomes a very strong magnet for the short sellers. So super interesting week. We've got a lot of dynamics here. We've got big levels around this 3730. Obviously practice risk management, guys. These are just TA levels and just my opinion. They're not for you to go and do anything with unless you've got your own plan. And as you notice, this would be a significant change, at least on the first time frame, and could put in place for us to start filling some of these gaps that we've left behind really far off. Now, the other thing is, think about that Nasdaq. This would be the higher time frame change of trend. And if that occurred, then you're talking about those really big gaps that were left during the aggressive short selling. So some big stuff here. First steps, baby steps first, get through this level, fill up to that 3780 in terms of where the previous gap was. I think I've got it. Yep, I've got it measured here. So that's that previous gap. Then we have the resistance and then we have the rest. So there is a chance that this market might rally this week, and hopefully it does, to start to give some reprieve to what's been an aggressive short off. But if it keeps going, 3,500, what do you guys think in the comments down below? If we go through some of the expiries in the subsequent weeks, what I notice a lot of is a huge amount of puts sitting around these 3,500, 34.5 kind of levels. So these two levels seem to be really critical here. And even going into the expirations this week, and if we're talking about obviously the 24th, you'll notice that the max pain's still at 384. Not that that, of course, is giving us that many signals, but still very strong put levels, all sitting around 345. Strange. I think we'll remember 345, 350. We'll put a huge level on that in the future. And if that's going to be where the market ends up defending, well, that is going to be where it is. Calendar for the week ahead. If you didn't watch our other videos, it's important to know that there is a bunch of information coming out. Obviously, Fed Chair Powell coming out to annoy us all on Wednesday, June 22nd, is coming out 9:30 a.m. New York time. That'll be so much fun. We always love it when Powell comes out, Papa Powell. And then 10 a.m. on June 23rd. And then we go on to the weekend. So there's a little bit of information coming out here for the US. Obviously, Papa Powell and his effects on the markets statistically have been negative then positive in terms of when he opens his mouth and then the reality afterwards. But do be careful in these markets. These are going to be ones that can move like this. And just because we saw some of the biggest short selling in the history of knowing the recorded levels, it doesn't mean that it is going to squeeze and cover up, but of course that is a case to be made on the markets. Thanks so much for watching. Subscribe if you enjoyed the video. We'll see you in the next one. Bye for now.